Hello, everyone, and welcome to our Home Refinance and Equity webinar presented by Signal Financial Federal Credit Union. We thank you for taking time out of your day to hear us out on what we have to offer today. And before we go into our content, we wanted to do some quick introductions. So my name is Saeed Halim. I'm the VP for Real Estate and Consumer Lending. I'm joined by these two great gentlemen that I have here today that are going to introduce themselves as well.
Hello, everyone. My name is Rob Cohen. I'm a senior mortgage loan officer here at Signal, and I'll be happy to answer any questions that arise from this seminar.
Okay. Hi, my name is Phil Alsheimer. I'm the other senior mortgage loan officer here with Signal, and be happy to run through any scenarios to fine tune what we can do for you.
All right. Thank you two gentlemen for joining us today. So the topics we're going to talk about today are, we'll do an introduction on refinancing and equity. Then we'll go into some scenarios to show how interest rate and term play a factor. And we'll close out with what the role of a loan officer is and how they may be able to help you with your particular scenario. So when we talk about mortgages, typically where people's minds go is for home buying. And we wanted to reiterate today the fact that mortgages go beyond just home buying, and there are several different things that you can do with a mortgage to help you, all depending on your scenario. So one thing you can do with a mortgage is refinance an existing loan, and the other is to be able to tap into the built-up equity you have in your home. And as I had mentioned, we'll go through some different scenarios for you. When making the decision to refinance, it's really up to the homeowner to decide what their goal is for refinancing. A couple different options and a couple different goals that are out there. One is to refinance and reset to a new term with a lower principal balance. And what that does is it lowers the monthly mortgage payments. So if your goal is to lower your monthly payments, that's certainly something that we can look at with you. Another goal could be to lower the interest rate. Right now, rates change, but they're at historic lows. So having lower monthly mortgage payments and lower total interest that you pay could save you tons of money. And then finally, refinancing can also be done to shorten the loan term and pay off your home sooner. If you're not sure what's right for you, reach out to us. Working with a loan officer can help you come to that conclusion and decide what's best for you. So as far as a rate and term refinance, a rate and term refinance is one where the mortgage that you have currently is replaced with a new loan for the remaining balance of your existing loan. So no additional cash out is taken. We're simply refinancing the existing balance that you have. To bring that example to life, I wanted to talk about a sample family that we have. Again, these figures are all examples. They're made up. So for your particular scenario, your payment, your rate, your balance, we'll be able to customize that and figure that out for you. The other thing to keep in mind here is the payments that we have on here are principal and interest. They don't include escrows, which would be your monthly tax payment and your monthly homeowner's insurance payment. So the Smith family borrowed $300,000 to purchase a home, and their rate was 4.5%. for a term of 30 years. So their scheduled monthly mortgage payment was $1,520. 8 years later, the Smith family decided they wanted to refinance and take advantage of a low rate of 3%. So because they've made their monthly mortgage payment for 8 years, their principal balance went down to $253,000. With a new interest rate of 3% and refinancing the existing balance of $253,000, they reset the clock on their mortgage for a new 30-year term, and their new scheduled payment is now $1,067. The result at the end of the day is they reduced their monthly payments by $453. So think about that. That can give a family a lot of additional cash and additional cash flow on a month-to-month basis. That's money that they can spend on tuition, other expenses that they have. It's money that they can save and put in their pocket for a rainy day. That reduction in payment can also go towards helping overcome and offset the cost for a refinance. So there's a lot of great benefits to refinancing, as you can see. And with that, I'm going to turn it over to Rob to talk to us about equity.
Hello, everyone. So let's talk about equity. What is equity? Equity is built by paying on your monthly mortgage, and as you pay principal and interest, and that principal gets knocked down. The other way is for appreciation. As the value of your property goes up, you start gaining equity with a combination of paying down on the principal and building up in value. So let's take an example and see how we can establish equity. So for an example, we have a house valued at about $300,000. We have a mortgage loan of $200,000. So how much equity do we have here? It is $100,000. That is not lendable equity, but that's how much it would be. Say you sold your house by yourself and you didn't pay any closing costs, you net out $100,000. Let's look at another example. So on a $425,000 value, your loan has been paid down to $167,000. So you have approximately $258,000 in equity, doing quite nice. Let's see how we can access some of that equity. One way to access it is to do a cash out refinance. And really what a cash out refinance does is it resets your current mortgage. You usually would do this if you have a higher rate than what's currently being offered. So if you had a rate of, say, 4% in today's market, we can refinance you at 3% and give you additional funds to do a lot of different things like buy a car, home improvement, debt consolidation. And usually your payments would be much lower than you would with carrying all that other debt. Now, there are reasons why you would do a home equity line of credit. Say your mortgage is currently at, say, 3.25 and the current rates are at 3. Well, you're all good on your current mortgage. You don't want to touch that. You've already paid down a couple of years. You don't want to reset it. So you would look to say, okay, how can I tap into the equity of my property? And one of those ways is a home equity line of credit. Again, we have two separate home equity products. One's a home equity line of credit. Think of it as a credit card. One is a home equity loan. Think of it as an auto loan where you borrow all your money, you get it fixed, certain term, 7, 10, 15, and it amortizes out, and that's it. Home equity line of credit, similar to a credit card, is you're established with a high credit limit. You're only paying interest on the money that you're using. You can use it, pay it down, use it, pay it down for up to 10 years, and then it will lock down and just amortize out. There are a number of things you can do with this line of credit, and let's look at some of the things we can do. So on a cash out refinance, we take the current mortgage, we replace it with a new loan, and let's take an example. Bought a house at $300,000, a rate of 4.5 for a term of 30 years. The scheduled monthly payment would be $1,520. They've been making their monthly payments for 8 years now, and so they're currently way down to $253,000. They would like to borrow an additional $50,000 for home improvements, finish a basement. So what we recommended in this situation is to do a cash out refinance, bring down the interest rate to 3.5. What that also does is lowers the cash stream because you're resetting it at 30 years. So the balance would be at 303, and the new monthly 30-year term would, and with the $50,000 will bring your payments down to $1,361. So you're pulling $50,000 out and your payment's still dropping from your original mortgage payment.
Yep. Very powerful stuff. And again, very useful for anyone who has the need to take out money. And I don't know that everybody out there realizes you could potentially draw money from the equity in your home and still end up with a lower monthly payment.
Thanks, Saeed. The home equity line of credit, as we call in the industry HELOC, it's a revolving line of credit similar to a credit card, but it's secured on your house. The Johnson family borrowed $300,000 to buy the house. Again, they owe $253,000. They would like to do some home remodeling and some debt consolidation and maybe even some tuition. They established a $50,000 home equity line of credit, and they only access that when the money is needed. So you're not paying interest on it. So when tuition starts in September, you pay at that point. But you might have had it for already 6 months and not paid a thing on it. Your home improvement, you may be getting bids from contractors, and you have it established, but you don't need to use it until you have to make your first payment. So to the contractor. So it really is a powerful thing.
Good.
Here are some uses for your home equity line of credit or a cash out refinance. As I said earlier, tuition, debt consolidation, credit card consolidation, medical bills, renovations, putting a new family room in a deck, renovating a bathroom. And some people will use it to buy an automobile or a boat or things that you love because you've established equity, your house is appreciated, and it's almost like getting something nice for free.
All right. Now PJ is going to take us away. Thank you, Rob. PJ is going to take it away with some different examples that'll show us how interest rate and term play a factor.
Okay. Our first example, we're using a $350,000 loan at 5% for a 30-year term. The scheduled principal and interest is going to be about $1,879 per month. And over the life of the loan, you're going to end up paying $326,395 in interest. So second scenario, if we reduce that by 1% from 5 to 4%, same loan amount, your payment goes down to $1,671, which is $270 or $207 less per month. But more importantly, over the 30 years, it saves you almost $75,000 in interest. So another thing to look at is shortening the term. If you want to go from, say, a 30-year loan to a 15-year loan. So on a 30-year loan, in this example, 4.25%. Monthly payment would be $1,722 per month and a total interest of just under $270,000. So if we were to shorten that term to 15 years, the interest rate would be lower, in this case 3.5%. The monthly payment would be a little bit higher at $2,502, but it drops your total interest to just over $100,000. So you do have a $780 a month increase in your payment, but it saves you almost $170,000 in interest, and your loan is paid off in 15 years versus 30. 15-year term can be very useful if you're thinking about retiring. Let's say you want to retire in 15 years and go into retirement mortgage free. So if you pay a little more on your mortgage, shorten it down to 15 years, and then when you retire, if you're going to be staying in your house, having the mortgage paid off will save you, in this scenario, $2,500 a month. You know, with most people have a reduced income in retirement, so that can help you with your finances.
Very good.
Another option that we have on fixed rate loans, we have adjustable rate mortgages. Some people are afraid of adjustable rate mortgages, but they can be a very good tool to use in your financial planning. We have a 7-year arm that is fixed for 7 years. And if you use an example of $350,000 at 3.25%, then your principal and interest payment is $1,523 per month. And after 7 years, you'll have paid your loan down to a little less than $296,000. Now, if you were to use a 7-year arm at 2.25%, your monthly payment would drop to $1,338, about $185 less per month. Because the way the interest works, you're still putting more money into principal, so you're actually going to build equity a little bit faster during that 7 years, and you'll be down to $288,000. Let's say you're comfortable making the $1,500 payment. You could still take out a 7-year arm with the minimum payment of $1,338, And if you apply that extra $185 a month towards extra principal, so you're still paying that same $1,523 monthly payment plus your escrow. In 7 years, you will have dropped your balance to $271,000 and change. So you're accumulating over $24,500 in additional equity in that 7-year period by making the same payment as a 30-year fixed loan would be in this scenario. So again, if you're not planning on staying in the house, maybe you're waiting for the kids to go off to college and then you're going to move, then this can be a way you can either save $185 a month or accumulate more money in your equity.
All right, very good. Well, thank you, PJ. I'll go ahead and close us out with talking a little bit about the role of a loan officer. So again, these two gentlemen are here to help understand your scenario and understand your goals. A loan officer wants to figure out your priorities. Is it to lower your payment? Is it to pay off your home sooner? Is it to access cash? And once they have an understanding of what it is that you're trying to do and what's most important to you, then at that point, they'll provide you options that fit your needs and fit what you're trying to do. They'll give you a customized estimate of rate, payment, closing costs, be able to answer all your questions. And remember, a lot of the scenarios we walk through, those are all just samples. Those are just made up examples that we have for illustration, but these guys will be able to take your scenario, take your existing balance, once they take a look at your credit and your financial situation, they'll be able to give you what the rate is that you'd qualify for, and you'd be able to have something that's customized and tailored to you. And if you want to apply, these gentlemen would be able to start the process for you, and they'll guide you through the process every step of the way. So in closing, a couple of quick reminders and things that I wanted to call out is, of course, we're eager to help you with your refinance and equity needs. We can help with your refinance, and we understand that that's something that can help people reach their financial goals. Equity that's built up in a home can help with debt consolidation and funding future expenses. So a lot of what Rob talked about earlier, future tuition expenses, remodeling, emergencies that come up, medical expenses, all that good stuff. Equity line can help pay for those. And we encourage everyone to really leverage the expertise of our loan officers. And if you had further questions or wanted to start the process, feel free to go to our website to submit an inquiry, www.signalfinancialfcu.org, or you can call our main line, 301-933-9100, dial extension 106. That goes straight to our mortgage department, and we'd be more than happy to answer your questions, take a look at your scenario, and see if there's something that we can help you with. And one last thing that I also wanted to call out is, there's no obligation to do anything if you reach out. One of the things that I commend Rob and PJ on is they'll hear our members out on their scenario. We get a lot of calls of people that are wondering if, because rates are low, is refinancing right for them? And there are times where they find that someone's in a good position and it doesn't necessarily make much sense for them to refinance. They have no problem telling someone, hey, you know what, you're in a good place. I recommend that you just stay with what you've got. It's not that beneficial for you to refinance. So to me, that just speaks to their honesty and how well they evaluate whether or not it makes sense to refinance. Rob, PJ, was there anything you wanted to add in closing before we close out?
I just want to say thank you everyone for their time and effort and listening to us. And remember, stay safe.
All right.
No, thank you for tuning in.
All right. Thank you both. Thanks, everyone. Take care.